Hey there, I'm a minute late here. So, welcome. This is my third live stream in the series, and today I want to talk about something that's really cool, and that is the idea of if you're if you feel like you're in a kind of a rabbit hole, an endless cycle of debt, paying high interest credit cards that never seem to go away, or what if I told you that there's a strategy that not only pays off your debt but also builds wealth at the same time? Is that something that would be interesting to you? Um, it's called infinite banking and using a particular type of whole life insurance, like a banking system. And today I'm breaking down exactly how you can combine it with debt strategies to get faster results. Stick around because you'll want to learn something completely different that you probably never thought about before. Um, and we'll go from there. So, if you could consolidate all your debts into one, what kind of financial relief would that give you? A lot of people will do that. They'll find another credit card that's offering some period of time where you can transfer your high interest debt over to that one at either 0% or some low percent. And that's not a bad thing to do. You just have to stay on top of it. And it doesn't add to your wealth at all. It just can help you save a little bit on interest. And sometimes people get pretty desperate. They can go to certain services and get everything consolidated into one thing, so it's a more manageable kind of approach. And there's nothing wrong with that. It's for certain people. It's certainly a valid way to go. So I'll just kind of touch on some of the points I'm going to get into here. So reducing wealth and creating something called volume return of money at work, and that is something that not many people are familiar with. People tend to think of volume, rates of return, average rates of return, and that kind of thing, which gets bandied about by Wall Street and people in the equities markets and such. Um, so with infinite banking, what you're doing is you're setting up a system and you're basically redirecting some of your money or a portion of your money into these very particular and very specifically designed whole life contracts in order to create a cash flow vehicle. And there's sort of a hybrid of a savings line of credit that grows uninterrupted your whole life because it's a whole life policy. Um, and you can create volume return of money at work, which is a whole another thing I'll get into a little bit later. And you can reinforce that cash value as it grows, and you just continue to cycle it and do it over and over again. One of the main things that's really important to keep in mind about this is that we finance everything one way or the other. We either save up our money, that income that comes in, and set it aside to make purchases for whatever we need. Never mind all the daily things, just the groceries and all that stuff. We either save up and pay for it out of our pocket, as it were, or in many cases we borrow. We take loans out from outside lenders to get the stuff we want. So if you think about it, you finance everything. If you do cash only, you're still financing it. You're bringing it in, you're setting it aside, and then you're paying for that item. The problem when you do it that way is that then the money's gone, and then you're back to zero, and until you save up again, and you're back to zero. And on the other side, you're borrowing, you're paying off into multiple years, depending on what the thing is. If it's a car, a lot of times it's 5 or 6 years. If it's a home, it could be 15 to 30. You're paying all this money and losing a lot of interest to these lenders and getting back to zero. So what we want to do is get away from that. Um, Here's a kind of a sample story. So let's say Sarah has $20,000 in credit card debt at 20% interest and a $15,000 personal loan at 12%. She feels really overwhelmed managing these payments. And by leveraging infinite banking, Sarah uses the cash value from her life insurance policy to pay off those debts all at once. Now she owes herself at a much lower interest rate. Instead of worrying about multiple lenders, she's focused on building her financial future. So in essence, there's a ramp up to this, depending on your situation, where you put your money into the policy, it's growing guaranteed, and at some point when you have enough, You just tap into it for whatever you need. My wife and I, when we started this 10 years ago, our first policy, we had about 20,000 in cash value that we could put to work. We took a loan from the insurance company, collateralized by what was in the cash value, and paid off 2 high-interest credit card debts that were up in the upper 20s. This is back in 2014. And then the idea, ideally, what you do is then you say, okay, now I've taken over, I've assumed that loan, that debt. So you play this dual role of the lender and the client. And obviously, the lender wants the client to be responsible and pay back into the system. And while you technically are paying back to the life insurance company, in essence, you're paying yourself back, because the money that goes back to pay off the loan to the insurance company gets reapplied to your cash value to be used at a later date. So it's, in many ways, it's like using the same dollar over and over again. So there's a little bit of a ramp up. Everybody's a bit different. I've had clients where it might be a year or two before they can really start to go after and buy their debt. The other thing about these is a flexible repayment. These are unstructured loans from the life insurance companies, which just means that you take a loan out, they don't put you on the automatic payment plan right away like any other lender does. They just don't. It starts to accrue a simple interest. Usually it's in the, depending on the company, 5 to 6% typically, simple interest rate. You actually don't ever have to pay it back. It works better if you do, because the great Nelson Nash, who wrote this book, so I'll bring out here just to show you, is Becoming Your Own Banker. He called it stealing peas. Like if you have a grocery store and you just habitually feel like, oh, you can just take food off the shelf and use it for yourself without paying for it, then you're robbing yourself in essence. So this is a similar kind of a thing. And because they're unstructured loans, you can do it any way you want to. You could, if you have a couple of rough months, you don't have to pay it back ever, really. So it's unique in that regard. I don't know of any other type of loan that's set up that way, like these loan provisions with these whole life insurance contracts. So here's another example. Let's say we have Mike owns a small business, and some months his revenue is high, but in slower seasons, cash flow dips. So with infinite banking, he can borrow against his policy to clear 30,000 in debt, and then when the times are tough, he slows down his payments and not really worrying about penalties or anything. So there's a lot of flexibility. When you're more flush, you get it back into your system, pay the loans back. You're also paying annual premiums on these policies, and the way to think about that is more like a deposit. You're making a deposit. It's not a bank necessarily, but it functions like a bank when you do it right. And the other part of this is just saving on the cost of while you're building wealth, because when you borrow out of your policies, you don't take any money out of the cash value. It continues to grow uninterrupted because nothing comes out of that. The life insurance company lends you out of their general fund, collateralized by what you have in cash value. So that keeps growing regardless. And as you pay loans back, it just helps it grow bigger. It's earning dividends. These are all what are called participating whole life insurance companies, mutual whole life insurance companies, which means that they pay dividends. And that just means they're profitable at the end of the year. Those dividends get redistributed, and we set them up so it buys more life insurance, which keeps it tax-free and helps the whole thing grow. So, and then did you know that? So yeah, so that's the key. It's you're not tapping into the principal. You may have heard people talk about, don't lose your principal. You've heard Warren Buffett talks about this kind of thing. And that's why a lot of really successful people, they often don't use or tap into their real money or their principal. They borrow against it. Back in the days of really low interest rates in the banks, they would take low interest loans from the banks. Things have changed a lot in the last few years, of course. It's a different environment now, but you really get the idea. I want to just touch base on the idea of volume return of money at work. I'm just going to bring up, I don't think I can share my screen. I'll kind of go through it. So it's very different. So I'm just going to read from this. I just pulled this up earlier. Volume return of money at work refers to the total amount of profit or return generated by a business or investment, considering the volume of money actively circulating within that system, essentially measuring how much revenue is being produced relative to the total amount of capital employed. So it's unlike return on investment, which looks like net profit against initial cost. Volume return emphasizes the continuous flow of money going out to work and coming back into your system. That's why really infinite banking is it's a cash flow wealth creation system. There are so many attributes to it. And here's an example. Let's say someone wants to purchase a used vehicle. My wife and I did this. Both of the cars we have now, they're a little older, in 2015 and 2016 Hyundais. We really like Hyundais, and we bought both of them. One in 2015, one in 2016, used. They were 2 or 3 years old at the time, and really good shape with a local dealer who knew there were a lot of guarantees and a lot of good warranty and everything. And we, of course, went to pick them out, and they said, "Hey, let's walk over to our financing guy. We'll finance this thing." And we said, "No, we're going to pay cash." We didn't pay cash. We took loans out from our policies to buy both vehicles, one year, one the following year. And so to the dealership, looked like we cut a check. Well, we took a loan out from our system to purchase the thing. And then what you do is you create volume return of money at work. So how you calculate that is, let's say I looked up some averages for cars. Used cars in the US are typically, for this past year, are about $30,000, $500 a month in payments at about 12% interest rate. So think of it this way. If you have money at work, would be, let's say you have 30,000 in cash, like we did in our system. We take a loan from an insurance company, collateralized by our cash value, buy the car, cash to the dealer. At least they think it's cash. It's not really cash, but you get the point. And then we say, okay, even though we own the car outright, the responsible and wise thing to do as a banker, becoming your own banker, is to pay back into our system. And if we say we decide that, we do the math, we figured if had we financed it elsewhere, it would have been $500 a month. So that's a number we can live with. We can manage paying $500 a month for a vehicle. We were doing it before. We knew how to do this, so that's manageable. So think about this: 30,000 at work. That's the amount of money at work. 5,000 per month coming back in your system, paying back the loan to the insurance company, and that ends up being what is that? Hang on a second. 6,000 a year coming back to your system. And how you calculate it is the money at work is 30,000. There's 6,000 per year coming back into it. So that's 20% volume of money at work coming back to you, helping the whole thing grow. And if you do that for 5 years or more, obviously you don't have to, but the way Nelson Nash talks about it, when you start to function like a bank, you want that money always coming back into your system because it helps the whole thing grow. There are ways to, even when the policy loans are paid back, I work with my clients and teach them there are other places and systems that you can store it in, because sometimes with these policies, there's no more room to put new money into it. So, but we can account for that. And you just start to act like a bank does, where you have money and you put it to work for whether it's to pay off debt, buy a car, business equipment, loans to other people, whatever the case may be. It's completely up to you, no questions asked, and it's completely under your control. So I'm going to close it up here. It's been about 15 minutes. I hope you got something out of this. You'll see in the LinkedIn message about this, I have a little freebie in there. Feel free to click on and check it out. It's 3 critical reasons why becoming your own banker is a great idea. And I would encourage you to check it out. Feel free to reach out to me and be happy to talk further. I'll be doing another one next Friday. Then I'll be taking a little bit of a break over Christmas and then right after New Year. So thank you so much. Have a great weekend, and we'll talk soon. Bye.